For years, he was one of the most feared voices on Wall Street, a short seller who built a public reputation hunting down companies he claimed were frauds. When he published a report, stocks moved. He cast himself as a watchdog, the man willing to say out loud what others only whispered. But in early June 2026, a federal jury looked at how he actually made his money and convicted him of securities fraud. Fortunes had shifted when he spoke. The verdict, when it came, was not total. This is the story of Andrew Left and Citron Research, a case about the thin, blurry line between exposing deception and profiting from it. It is about a man who made his name accusing others of misleading the market, and who was ultimately found by a jury to have misled it himself. And it raises a question that reaches far beyond one investor. When the person telling you what to buy or sell is also secretly trading against his own advice, who is really being watched? To understand the case, you first have to understand what a short seller does, because it is one of the most misunderstood roles in finance. Most investors bet that a stock will go up. A short seller does the opposite. They borrow shares, sell them, and hope to buy them back later at a lower price, pocketing the difference if the stock falls. Short sellers make money when a company's value declines. That gives them a powerful incentive to find companies that are overvalued or outright fraudulent, and to tell the world about it. At their best, activist short sellers act as a kind of private police force for the markets. They dig through filings, question suspicious numbers, and publish research arguing that a company is not what it claims to be. Some of the most famous corporate frauds in history were first exposed not by regulators, but by short sellers who had money riding on being right. That role comes with a built-in tension, and it is important to see it clearly because it sits at the center of this entire story. A short seller is not a neutral referee. He is a paid participant with a direct financial stake in the outcome. When he tells the public that a company is worthless, he stands to profit if the public believes him and the stock falls. That is not automatically wrong. A person can be both self-interested and correct, and the market benefits when someone is motivated to dig up hidden fraud. But it means the short seller's credibility depends entirely on one thing, that what he says in public is genuinely what he believes and is doing in private. The moment those two things diverge, the watchdog becomes something else. The same platform that can expose a fraud can be used to manufacture one. Andrew Left built his career in exactly this role. Through his firm, Citron Research, he published reports and used a large social media following to make his case against companies he targeted. He became a recognizable public figure, quoted in the press, watched by traders, capable of moving a stock's price with a single report or post. For a time, the Citron effect was real. When Left spoke, the market listened, and prices often reacted within minutes. That influence was the foundation of everything. A short seller's public words only matter if people believe those words reflect his honest opinion. That when he says a stock is overvalued and he is betting against it, that is genuinely what he thinks and what he is doing. The entire value of the platform rested on a simple assumption of trust, that his public position and his private trades pointed in the same direction. According to federal prosecutors, that assumption was false. Left's rise came from being right often enough and loud enough to matter. Over the years, Citron Research took public aim at a range of companies, and Left cultivated an image as a fearless, independent voice, an outsider willing to take on businesses he believed were deceiving investors. He leaned into the persona of the watchdog, the skeptic, the man who could not be bought. His profile grew especially large around the meme stock frenzy of the early 2020s, when he became a prominent and polarizing figure in the public battles between activist short sellers and armies of retail traders. Whether loved or hated, he was watched. His audience grew into the hundreds of thousands, and with that audience came real, measurable power over short-term stock prices. Here is the crucial mechanism. When a figure like Left recommends a position to a huge following, say, publicly stating that a stock is a buy, or that he has covered his short and now sees upside, that statement itself can move the price. Enough followers acting on the recommendation can push the stock in the predicted direction, at least briefly. The recommendation can become a self-fulfilling prophecy for exactly as long as the audience believes it is sincere. And that, prosecutors would argue, is precisely what Left learned to exploit. The government's case was that Left figured out how to use his own influence as a trading tool, to say one thing to his audience while doing another with his own money, capturing the price move his words created before the audience could catch up. Think about how powerful that would be if true. A normal trader has to predict which way a stock will move. But a commentator with a large, reactive following does not merely predict the move, he can help cause it. If his words can push a price up or down, even briefly, then he knows something the rest of the market does not. He knows what is about to happen next, because he is the one making it happen. Prosecutors argued that Left used exactly this edge. He would take a position, tell his audience something that would move the stock in his favor, and then quietly close his position into the very reaction he had provoked, again and again, across dozens of trades. It was, in the government's telling, less like analysis and more like a magician forcing a card. The audience thought it was making a free choice, while the outcome had already been arranged. None of this would work without trust. If Left's followers had believed his recommendations were insincere, they would not have acted on them, and the price would not have moved. The alleged scheme depended on the audience believing he was exactly what he claimed to be, an honest, independent voice calling it as he saw it. His credibility was not a byproduct of the business. It was the raw material. The public reckoning began in July 2024, when the U.S. Department of Justice charged Andrew Left with securities fraud, and the Securities and Exchange Commission brought a parallel civil case. The charges laid out a specific and damaging pattern. Prosecutors alleged that from at least March 2018 through October 2023, Left used his public platform to recommend stock positions to his followers, and then, often within hours or even minutes, reversed his own trades in the opposite direction, profiting from the price movement his recommendations had caused. In plain terms, the accusation was a bait-and-switch. Left would tell the public he was, for example, long a stock and expected it to rise. His followers would buy, pushing the price up. And then, according to prosecutors, Left would quietly sell into that very rally, doing the opposite of what he had just told everyone, banking a fast profit, while his audience was left holding positions based on advice he no longer stood behind. The government also alleged something that struck at the heart of his independent image, that Left had concealed financial relationships with a hedge fund, disguising payments by fabricating invoices and routing money through a third party, and making false and misleading statements about whether Citron was truly independent. The watchdog who claimed he could not be bought was accused of hiding exactly the kind of arrangement that would compromise him. All told, prosecutors said the scheme generated at least $16 to $21 million in illicit profits. Left denied the charges and vowed to fight them, arguing that his public statements were protected opinion, and that expressing a view and then changing one's trades is not a crime. The question would go to a jury. The trial put the mechanics of Left's business in front of 12 ordinary people and asked them to decide whether it was commentary or fraud. After 2 days of deliberation in early June 2026, the jury reached its verdict. It found Andrew Left guilty of engaging in a securities fraud scheme and guilty on 12 of the 16 additional counts of securities fraud tied to specific trades. On the remaining 4 of those counts, it did not convict him. The verdict was mixed, but decisive on the central charge. It was, in the words of one description of the case, a landmark result in the world of activist short-selling. A jury concluding that a prominent market commentator had, on most of the counts it considered, crossed the line from opinion into manipulation. The core of the jury's conclusion was the gap between his words and his trades, not the fact that he shorted stocks, not the fact that he published harsh reports. Short-selling is legal. Publishing critical research is legal and even valuable. What the jury found unlawful was the deception, telling the public one thing about his own position while secretly doing the opposite, and concealing the relationships that undercut his claimed independence, using the trust of his audience as the very instrument of the fraud. The consequences are still unfolding. As of the making of this video, Left has not yet been sentenced. A sentencing hearing is scheduled for later in 2026, and the charges carry the possibility of significant prison time. He has maintained his innocence throughout and has said he intends to appeal the verdict. Under American law, he retains that right, and the case is not final while appeals remain. But the symbolic damage was already done. The man who had built a career accusing others of misleading investors had now been found, by a jury of his peers, to have misled them himself. The Andrew Left case is not really about short-selling. It is about trust, information, and the hidden conflicts inside the voices that tell us what to believe about money. The first lesson is about the difference between an opinion and a weapon. There is nothing wrong with a short seller publishing a bearish report or a commentator sharing a strongly held view. Markets need skeptics. What the jury found unlawful was not the opinion but the betrayal of it, saying one thing to move a price and then trading against your own words. The line is not about whether you are bullish or bearish. It is about whether your public statements and your private actions are honest with each other. The second lesson is about hidden conflicts of interest. A market commentator's value depends entirely on the audience's belief that he is independent, that he is telling you what he thinks, not what someone paid him to say. The allegation that left concealed payments from a hedge fund, disguised through fabricated invoices, strikes at that foundation. When you cannot see who is really behind a recommendation, you cannot properly weigh it. Disclosure is not a bureaucratic formality. It is the thing that lets you judge whether to trust the messenger at all. The third lesson is the most modern. Left's alleged scheme worked because he had a large, loyal, fast-moving audience that could push a stock the moment he spoke. In an age where a single post can move a market, the power of an influential financial voice is enormous, and so is the temptation to abuse it. The tools that let one person inform millions are the same tools that let one person manipulate millions. The case is a warning about what happens when influence outruns accountability. And there is a final irony that gives the story its weight. Andrew Left made his name as a hunter of deception, a man who profited by exposing what he said were other people's lies. The jury concluded that he had become the very thing he claimed to fight. It is a reminder that the label of watchdog is not a character reference. The people who position themselves as the guardians of honesty are not automatically honest, and the more trusted a voice becomes, the more carefully it deserves to be examined. In the end, the market's oldest defense is also its simplest. Follow the money and ask whether the person telling you what to do is quietly doing something else. Andrew Left built an empire on asking that question of others. His conviction is what happened when a jury finally asked it of him. This video is for educational and informational purposes only. All information is sourced from publicly available documents from the U.S. Department of Justice, the Securities and Exchange Commission, court records, and credentialed news organizations. In early June 2026, a federal jury convicted Andrew Left of a securities fraud scheme and additional counts of securities fraud. As of the production of this video, he had not yet been sentenced. A sentencing hearing was scheduled for later in 2026. He denied wrongdoing, and he stated his intention to appeal. A conviction that is subject to appeal is not final. Nothing in this video should be understood as a statement that any allegation not resolved by the jury's verdict has been proven. Source links are available in the description.